having me on your show. See, I think that metals have been star performer for the last several quarters or so, and largely it's because of increase in global prices, and of course, rupee depreciation has benefited select metal stocks as well. But I think it's like a moving train, and if I was already invested in metals, I would remain invested. But at these levels, I'm not so sure. Usually, the best way to play cyclical stocks is when there is a down cycle, and this certainly isn't a down cycle. It's more like a mid cycle for metal companies. So I would just be a bit cautious and neutral on this sector as a whole. But whenever the timing is right, I would still go for the non-ferrous metals, say copper, aluminium, zinc, because I think the prospects over there are far better, especially for copper. And one should especially keep a very close eye on Hindustan Copper. They are undertaking a massive expansion, and there are execution risks, no doubt. But if they're able to generate those kind of volume growth over the next 3, 4 years or so, then this stock can certainly deliver even higher returns from these levels. It's been a star performer, trades at very, very rich valuations. But I think investors are forecasting very good times for Hindustan Copper in terms of volume.
Okay, so that's on some of the metal names. Deepan, hi, morning. We're seeing some interest coming back to the FMCG space in terms of the moves that we've seen. It seems like it's emerging as a safe haven spot in the market right now. Do you agree with that?
Yeah, good morning. See, FMCG has always been a safe haven, and there was a time it was a growth industry also. But at this point of time, I think a lot of categories within the FMCG industry have reached maturity. And sure, if you want to remain invested, to play safe, you have to invest in the market, cannot convert to cash. Then you may look at FMCG stocks. Also, there's no denying the fact that there could be a trading rally in FMCG. They have underperformed, they are under-owned, there could be short positions because of base effect and lower raw material prices. You may see this quarter, next quarter, these companies reporting decent numbers. But I would say that from a long-term perspective, FMCG is a sell at every rise. And India's consumption basket has changed tremendously over the last 5, 10 years or so. And there are better ways to play the consumption trend rather than FMCG. There's retail, there's reality, there's automobiles, and there are so many of these new age businesses. And if you still want to remain in FMCG, I think the best bet is the quick commerce companies like Eternal or Swiggy. I think that they are really the new FMCG. If you ask me, right now the valuations are rich and to an extent controversial, but give them 5, 10 years or so, and they will start reporting solid profits and still be able to generate adequate growth after that period.
At what point do you buy these, Dipan? Because you, you, you believe that currently valuations are expensive because Eternal will come out with numbers as well. So you've got that expectation. We'll bring you that expectation, viewers. But Dipan, with regard to a couple of these counters which you spoke about, the platform companies, at what point do you buy them?
Yeah, I think that I would look at these companies, I would buy them at any point of time. You see, because these are long-term plays. When you buy an Eternal or a Swiggy, if you are thinking that you'll own it for a quarter or a year, then it's not going to work out for you. You have to think of these companies in terms of 5-year, 10-year type of outlook. And the maximum money is made even in FMCG stocks, even in growth companies when you hold them for long periods of time, because end of the day these companies also are going to witness a lot of volatility and disruption and destabilization in their businesses, and how they cope with that is important. There's emerging competition as well which will try its hand at quick commerce, but end of the day I think if the underlying business model and the systems are strong, then these companies will be the companies to reckon with in the future. So I would say that in every portfolio you should have a small allocation towards these new FMCG or new platform companies. It could be at the expense of HUL or a Colgate. I think if you take a 3, 5, 10-year view, you are better off in such platform companies rather than a HUL or a Colgate, because the going will get even more tough for such companies. Whereas the likes of Swiggy and Zomato and all, they will try and do something new, get into new categories, improve their unit economics, and then expand geographically as well into tier 2, tier 3 in a far more rapid way. So there are far more levers to generate growth for these platform companies than for the FMCG companies, or for that matter, some of the other consumption companies.
Okay, so that's the view on the new age FMCG.
Sir. that there was a time when you could only order a Domino's pizza by making a phone call or using their app, and they're the only delivery that you could get. But now there is so much of choice for households, for the generation Z and X to order food from restaurants near and close by. And that has affected the QSR industry deeply. The same store sales growth have been extremely disappointing. You have a company like Westlife, which have been around for decades, and yet they're just not able to generate adequate profitability. Same is the case across the board. And I think within the QSR industry also, they realize that the challenges are just far too great for the industry. Therefore, a lot of them are diversifying overseas, buying franchisees in other countries, South Africa, Turkey, Malaysia, Indonesia, some of the other growth markets. And then now we have seen consolidation where two players have merged to form the largest QSR company in India. So I would remain underweight in the QSR segment purely because of the fact that the underlying, in the fundamental of the industry have been impacted by food aggregators, and it's just best to they may have occasional good quarter, no denying that fact. There could be trading rallies, but I don't see them creating significant secular long-term growth per se.
Deepan, how are you looking at persistence numbers? They looked quite strong at the outset. I'm trying to understand whether within mid, small cap IT or rather mid cap IT, moreover, is should this be something which viewers, listeners, investors should surely consider, and at what price, according to you?
No, really, we should ask the management what they are doing so different. Because when the entire industry is growing at single digit top line and just about trying to maintain their profits which they generated last quarter, there is one company which is delivering strong double digit high teens type of growth rates. As a measure of disclosure, we are invested in this person systems, have been so for many, many years, and it's been a great value creator. So as I said, I think that but it trades also at very expensive valuations. So maybe at corrections you could look at getting into this company. But as investors, I would remain invested for a long period of time. There's definitely something different about this company as compared to a lot of other software services companies. And now that the entire industry is at least showing some green shoots, I would say that person systems will may again outperform the industry and generate maybe even higher growth rates as the overall industry growth dynamics improve. And by the way, I think that largely investors should look at the software service sector very, very closely. You could have many winners over there, many surprises as well. Large cap, mid cap, small cap. I think I don't expect them to have a kind of a similar growth and returns profile, but there is a chance that you may find a good winners over here in stocks which are beaten down, which have underperformed. But then a few good contracts, perfect placement, right presence in the right industry, I think can do the magic. When you look at LTI's numbers also, I think they were pretty impressive. Management saying that by end of this year they should go back to double-digit growth rates, and that's very good for a large-size company like LTI.
Okay, so that's on some of the IT counters. Kunal, we'll get a chart check on Tata Motors in a bit, but Deepan, talk to us about the latest development that we're seeing in Tata Motors commercial vehicles. They've launched 17 new trucks yesterday. This is both across ICE and their EV segments. Talk to us about how better or how well placed are you seeing Tata Motors commercial vehicles, given that there is so much competition in the commercial vehicle space, but market share has been an issue for them of late. So, talk to us about how you're seeing that space develop.
Yeah, I think it's good that the company was split like this, and it gives increased focus to the commercial vehicle division, now that it's separately listed. But end of the day, I think that our preference is for Ashok Leyland. More consistent performance, uh, have been able to increase or maintain market share. There's the export opportunity, and then they have this investment in that EV subsidiary, which is gradually creating value because of right positioning. So I'm positive on the CV industry. I think underlying numbers, monthly sales numbers justify that they are in a cyclical upswing. It's a great play on economy, which is starting to do much better than before. 7-8% type of GDP growth rates, industrialization certainly benefits the CV segment per se. So I would remain invested in Tata Motors CV. They could surprise now that focus is there on this company. They could surprise with a very decent set of numbers. But right now, I think the better play would be Ashok Leyland. But nonetheless, I think auto as a sector where investors should remain overweight in, and preference could be across the board. Could be tractors, CVs, passenger vehicle companies, two-wheelers. I think we are seeing very good growth dynamics over there. And let us see whether these kind of monthly growth rates are sustainable.
Okay, so that's on what's looking good in the CV space. Stay invested in TMCV if you have a holding is the call coming in. But Ashok Leyland is the preferred pick of Deepan. But Kunal, coming to you, let's talk about Tata Motors PV. With limited chart history for CV, but talk to us about how you're seeing Tata Motors PV shape up on the charts.
So it's been one of the weak stocks. Without any doubt, the stock has been an underperformer. It's below the long-term averages. It's at a multi-week low on closing basis also at current levels of 330, 340 where it's trading right now. So on the near to medium-term charts, stock has shown incremental weakness. Every time you've seen the stock, showing any kind of a reprieve on the upside, you've actually seen a point where the stock has been sold into. But I also believe that the auto sector at large, I think, is going through a major uptrend. We've seen many of these auto stocks doing fairly well for themselves, over the last say 5-6 months from August somewhere, for these auto stocks. So I think in that context, Tata Motors PV has been a huge underperformer in that aspect. But there would come a point where the stock would try and play a catch up with the underperformance with respect to its other peers. So my sense is that maybe I think closer to 320 mark, 325 range is where I would believe that the stock could look a little bit more attractive than what it is right now, and that could be a point where the risk reward starts to look far more better for Tata Motors PV. So it's a stock which is already going through a zone of underperformance, but I think closer to a point of 320ish, the stock could probably offer a good risk reward to go for a contra buy.
Okay, Dipan, if I can come back to you with regard to chemicals, and within the chemical basket, SRF in particular came out with numbers. Now, favorable product mix, of course, aided the kind of numbers that we saw. But if one were to look at the commentary, there's still a quarter to go with regard to demand recovery. But once demand recovers, this could be a space which could start looking very interesting. And if so, what's the timing of it, in your opinion?
No, I'm very positive on specialty chemical companies. First of all, they benefit from rupee depreciation because a lot of the products are priced or take the price from international markets, and because they are quoted in dollars, they benefit to that extent. These companies have been ramping up capacities across the board for domestic market, import substitution, global markets as well. And they're doing backward integration to improve their profit margins. And in a way, I think we should expect a cyclical upswing. We saw what happened in metals. So typically, when there's a commodity upcycle, then eventually it'll get around to all the commodity players, even some of the specialty chemical players, and a lot of these companies are also going in for long-term supply contracts, which should start accruing or at least generating revenue in the near future. So very positive on all of these specialty chemical companies, including SRF. As a major disclosure, we're invested in SRF, and if you have them, if you hold them for a reasonably long period of time, the long-term growth rates are pretty decent for these companies, and a lot of them are now becoming global players. Third, fourth, fifth largest manufacturer of X, Y, Z type of a chemical, which gives them a very good competitive edge as well. So yes, positive on all specialty chemicals, including SRF.
Okay. All right. So that's Dipan's view with regard to chemicals. Positive, at least, is the view. How is it looking on charts?
Yeah, I think SRF is the only one which I believe looks attractive from the